Okay, this is a quick video for friends on the Discord group where I promised I would explain briefly how the market auction process worked. Now, let's imagine we had a market selling apples. Now, the first thing that's going to need to happen is people need to offer apples for sale at a specific price. So in this instance that I've drawn here, we have apples on offer for $4, $5, $6, and $7. There's one apple for $4, one apple for $5, one for $6, and one for $7. So in effect, a miniature price ladder. Now, these people offering apples will just wait until someone wants to buy the apple from them at that price. So now we have our buyers here, our market buyers. These are people who want to buy an apple and will buy it at whatever the best price available is. They just want an apple, basically. So what will happen is this guy comes along, he wants one apple, so he hits buy and he buys an apple at the best price, $4, and that apple is then cleared. And we see that. Then the next guy comes along, he clicks buy, he $5 is the next apple on offer, and the next guy comes along, hits buy, and he takes an apple for $6. As you can see, as they bought apples and cleared these prices, if this is a chart, this would be your bullish candle busy forming here. Every time a price level is cleared, it ticks up and your bar gets bigger and bigger. Now, in this case, the market is our example market is fairly balanced. The number of apples on offer was quite well matched to the people wanting to buy. Now, what happens, for example, is we have, say, for example, 5 apples on offer here. So when guy number 1 comes along, he hits buy, and you see it'll bar come up, and we will have 4 apples on offer. Next guy comes along, hits buy, and we'll have 3 apples on offer. Now, note one thing: this doesn't move because the lowest price is still 4. Our last guy comes along, buys an apple, and there are still 2 left. Now, all our buyers are finished, but there are still 2 apples on offer for $4. So if you're watching this on your chart once again, it would look if you only had a candlestick chart, it would look like nothing was happening. Because in reality, these transactions were happening, you just can't see it in the candlestick chart. This is what they call absorption. So here, the market will be termed as thicker than because it was able to absorb the buying without moving up. Ultimately, of course, if more and more market buyers came in, eventually this would move and this would tick up. But that is an example of a thick market and what they call absorption. Now, another case, we could have this, the other way. In essence, one guy comes along, and when he buys, he wants to buy 3 at once, but there's only one apple on offer at each level. So he instantaneously, when he hits buy, it instantaneously will clear all 3 levels, and your market will spike up. So that can be what happens when you see a sudden spike, is these orders overwhelm these resting orders very rapidly. So in this would be an example of a thin market where the number of aggressive buyers overwhelms very easily the number of resting sellers on offer, and your market moves up rapidly. So that would be, in this case, this would be the example of a thin market. As you can see in both of these, in all the examples, we ended up with the same price bar. But looking at the candle, you can't tell if especially after the fact, you can't tell if it was a thin or balanced market because the candlestick doesn't show this information. You can't tell what the transactions were that happened inside of that. Now, these market orders, the people who want to buy right now, effectively the people who click in buy and sell on your trading platform, these are also your stop loss and take profit orders. What happens is your stop loss and take profit orders don't sit in the market. You can't see them, despite what you hear on YouTube. No one can see your stop loss orders. The only reason it goes to your broker is so that your broker can execute it when your trading platform is turned off. So your broker holds a pool of these orders, and when price trades down to that price level, your broker executes them as a market order, effectively clicking the buy or sell button for you. So this process I just illustrated now is what happens when groups of stop loss orders go off. Bear that in mind. That'll be quite important in the next video on the liquidity. This side is the limit orders. This would be when you place a limit order with your trading platform, and these do sit in the market. In a real market, it looks like this is what it looks like in the actual market. This is now ES. This is the ladder in ES. So here we have sellers who are making an offer. This is the example here. Here we have the example that we haven't seen yet, the opposite of this, buyers who are bidding. So there are 11 bid at 38.75s, 12 bid 38.50s. Here we have 10 bid 39.25, 14 39.50, 15 39.75. So these guys have placed a limit order in the market, and they're waiting either for someone to buy, here what they call lift the offer, or someone to hit sell on their platform and hit the bid. Now, again, it always trades at the best available price. So when you click, if you were to click buy now on your platform, you would get 75.39.25 is your price, because that's the lowest offer. If you were to click sell on your platform, you'd get 75.39, because that is the best bid available, and the number here would drop by 1 if you're in the live market. Now you can see the process. This is what the process looks like in real life. Down here we have our bids and offers, and in the middle column you'll see the market orders. Let's start up. In the middle column you'll see, now these numbers you'll see change all the time. There was one, there was one, and of course it's not static. People add and remove bids and offers all the time. So far only 2, and there were 6. So 6 people bought at that price there, and the price jumps up and down as the levels are cleared. Obviously it's a lot more back and forth trading. Obviously sometimes the trading becomes very one directional, but as you can see, you can't see the actual market orders. So these could be people hitting buy or sell, they could be stop losses, they could be take profits. There's no way to tell. All you can see is people trading, lifting the offer or hitting the bid, and price ticks up and down. So there, see, quite often you'll see it's ticking down 1, 2, 3, 4, but the price is moving because the buyers are clearing their bids and the market's ticking down. Now that is in essence the only reason the market moves. I do get an impression sometimes that people believe that the momentum is sort of like a car, or pushing a car, where if a bunch of orders go off, it pushes the car and the car kind of just keeps going. That is not correct at all. As you saw from our Apple order, and you can see here, once one order is executed, a market order is matched with a price on a limit order, and that's it. Nothing else happens. Momentum is a side effect of either many of these guys hitting or acting, or one big one taking one little one. So you always need more and more and more and more buyers or sellers to keep coming into the market to keep it moving. A burst of orders alone doesn't create sort of a momentum that keeps pushing the market forward. I don't think you see the market that way, but I know some people do, and that's not true at all. Because as you can see here, we're having lots and lots of orders trading, 12, 5, 2. People are pulling, people are adding, and the market's obviously just chopping in this area here. So we had a 7 or 4, lots of people pulling. These are the numbers being pulled, and we get this back and forth trade all the time. And at some point, it'll probably break out and make a more one-directional move, in which case we get very little traded on the one side, a lot more traded on the other side, and that will create your fair value gap. And that is in essence why the market moves. This auction process of people buying, of market orders buying from the limit order, is the only reason the market moves. If that doesn't happen, the market will move. Right. That's that for this video, and then I'll make another one now where I touch on this liquidity in the TTM strategy.